What's up, everybody? It's Matthew Mickey here with Trading for Veterans and Service Members. And so the class I want to give you is going to cover volatility, liquidity, and the Fed, right? And this is going to be a multiple part series, right? Because it's a lot of information. But after this, you should be able to understand, how to trade from a top-down macro and a bottom-up micro approach to ensure that you're taking the highest probability trades possible, right? And so certain market conditions demand you to be a certain type of trader with different expectations and different time horizons. And if you do not consider this, you're going to blow up your account or become an investor in a stock that you don't want to be an investor in, right? So, as a trader, you need to recognize which volatility regiment you're in and trade it in the way that fits the current market conditions, right? We're going to talk about stagflation, deflation, expansion, and inflation later on in this series. However, right here is the basics to my rule books, right? So I have buckets of volatility, right? So when the VIX is below 19, I consider that the money bucket. When it's between 19 and 28, I consider it the whipsaw. When it's above 28, I consider it a danger bucket, right? And why is this, right? It's because money flees rise in volatility and seeks fall in volatility. Another way to think about it is low volatility equals high liquidity. Plenty of buyers and sellers. It balances the market out, right? High volatility equals low liquidity. Very few buyers and very few sellers, right? We have to think of it like this, right? We trade in a market, whether it's futures, forex, equities, or whatever, where people trade on credit and use leverage, right, or margin. And the broker holds a percentage of the contract values as collateral on your trades, right? That percentage is lower during the session and higher if you carry a position overnight, especially in the futures department, right? So think of it like this. We are in a low liquidity market, and this is not new news. It's a credit-based market, and there's a couple of players within this market, right, which we'll discuss later in the class. But either way, it's low liquidity, low volume equals volatility, right? What is volume? The amount of money or orders that are in the market, right? So why? Let's say we'll get into that here in a little bit, right? So back to this sheet, right? So when the VIX is below 19, the NASDAQ volatility indicator is below 25, crude oil is below 36, gold's below 17, the US dollar is below 95. I consider that a buy and hold easy market, right? That means I'm going to be a portfolio manager. And for me specifically, the risk that I adhere during this time is I manage a long short options portfolio, and I usually buy the options at the money with 2 to 3 month expiration, and I usually hold it for 20 to 60 days worth of volatility, right? And then when I need a hedge, I hedge with options with expiration dates this week or next week, right? If you look at the whipsaw, right? VIX is between 19 and 28, crude oil is 36 to 50, gold is between 17 and 22, US dollars between 95 and 99. This is my chop market, right? As in volatility is starting to pick up, right? And we're going to talk about what's happening from an economical standpoint and a Fed Reserve standpoint later in the session, right? But it's characterized by sharper ups and sharper down moves, or whipsaws. It's kind of difficult to trade if you don't know what you're doing. You get chopped up, right? But I continue doing my long short options portfolio. But I'll do debit spreads and butterflies, and if I am naked option, I'll buy 4 to 6 months in the money with a delta of 70 or higher, right? And then I'll hedge by selling premium 1 to 3 week expiration, right? Or I will hedge using futures or forex so I can be in and out and trade the daily chop. So the danger bucket is when VIX is above 28, crude oil is above 50, gold's above 22, the US dollar is above $100 or whatever. this is when, like, from an economical cycle or business cycle, we're at the peak, or we're experiencing stagflation, or we're about to go into deflation. And like I said, I'll teach you guys all that later, right? But what I will tell you is you get sharp, fast movements in both directions, right? And it's only and it's designed from a economic regiment, like it's designed to be up and down, because certain things are happening with the Fed and the economy that forces it to be that way. And this is only suitable for day trading, in my opinion. So, like, I usually don't like getting my face ripped off. So what I'll do is, during these conditions, I'll only trade futures and forex, and that's in and out. And I'm collecting 5 handles at a time, and it's all based off of local liquidity through stops or through imbalances, and my books are closed. I have no portfolio. I'm looking for short-term trade opportunities only, right? So think of it like this: the money bucket is 60% of the time, and I'm looking for betas greater than 1, right? The whole market is moving up, right? You can trade leverage risk on in this environment, options, futures, and individual equities, right? But as volatility increases towards the whipsaw bucket, you should be reducing risk. Fewer options per trade, fewer contracts of futures, smaller stock positions, lightening up your portfolio leverage, and booking some gains, right? If volatility continues to increase, you should be in cash. By the time you get to the danger bucket, right? This often happens naturally, as the whipsaw bucket will take out your stops anyway, right? And once you're in the danger bucket, you can take individual opportunities as you see them in very, very small size without leverage margin or any of that. Remember, if you're right, you get a big win because of the elevated volatility, and if you're wrong, you won't be broke because you're using smaller position sizing. Retail traders, like, we typically understand that it ultimately comes down to acceptance of time and price, right? And you focus time horizon to capture and squeeze the most out of your trades. Most come from the market conditions, right? And market conditions are in the form of liquidity and volatility. And that comes from the amount of liquidity that is available. Like, we are in a market where people trade off of credit and use leverage, right? Because of the lack of liquidity, right? Now, when there's a lack of liquidity, then liquidity has to be engineered with the orders that's in the liquidity that's in the market, right? Certain factors go into this, but if macroeconomic factors and Fed reserves are telling us that the economy is slowing and inflation is going, or a seasonality is telling us to sell and go away, or the Fed is telling us that they're going to tighten up their balance sheet, does this mean that all the market will crash down? Absolutely not. It's called a shock for a reason, and the factors I am discussing are not that exogenic shock. Why? Because most of the time they're seen from miles away, right? And we're going to get into what that looks like later in the sessions. All right. So with that being said, let's look at what engineered liquidity looks like on a typical chart day trade. That way, when I explain it from the bigger picture from the Fed, it makes a little bit more sense, right? So when the market is stuck around one price, right, and there's a lot of buyers and there's a lot of sellers, then we know that's a liquid market, right? There's a lot of liquidity in it. When it moves quickly and swings wildly, there are fewer buyers and sellers, right? And since markets are fractal, we can look down at lower time scales and see this from volume profile or just candles or whatever you have to use, to see it. I prefer using TPO charts, but that's me. But I'm going to give you an example using candlesticks, since most people are familiar with candlesticks, right? So let's say the market you're trading is having liquidity dry up, and volatility is starting to pick up, right? You must understand what is happening, right? So look at the chart, right? If a large buyer steps in and places 100 orders, right, but there are only 10 sellers at that price, well, the market has to move to price imbalances, which you can see highlighted in yellow right here. There could be 10 sellers in that, because there is a price imbalance to the upside. That means there's more buyers than sellers that don't have sellers, right? And then it's going to continue, and it's going to run, sell stops, right? And sell stops are stops below, structure, right? So as you can see in the picture, it runs those stops and it fills that order and then it rips back up, right? And that's volatility at the local level. So remember, ES is trading at like 4,100, right? And there's 100 sellers looking to offload one contract each, right? And these sellers could be people longs trying to take profits, or short selling something they don't own and buying it back at a cheaper price. Regardless, they're sellers, right? Now a buyer steps in with 1,000 orders, right? But there's only the 100 sellers at 4,100 trying to sell the one contract, right? The market now has to go to a sell-side imbalance or an area with sell stops to find and fill 900 more contracts. So they'll drop the bid or lift the area to get to the price up to the liquidity at another price to offer the buyer his 900 contracts, right? This is seen especially across forex and futures and indexes. When it comes to equities, like equities have their own way of engineering liquidity that would cover when we get to the equities place, right? Now, to get the price to a certain level, it has to displace to that level. And the tempo and aggressiveness is key to the displacement. And that's how we can tell if we are trading with the smart money, the sharks, or the guppies. Like you have to pay attention to the order flow, which is orders coming in at the time to see what is exactly is going on. If it's volatile, it's searching for liquidity. So you can see this on the higher time frame charts. You can see what liquidity imbalances are in the body of the candles, right? And before we trade, we need to analyze the market from a weekly, a daily time frame, a macro time frame, what the Fed's doing, all this stuff, right? We want to see if we can establish likely points for highs and lows for the weeks, as well as area illiquidity, right? Some things we will look for is sell stops, for people who are long, and sell side price imbalances, right? And I know this is confusing. It's only to give you an example, because that way you can see it, understand it a little bit better when we get into liquidity from a higher picture, right? Now liquidity is something like everybody always talks about as being important, but they never explain it and how it affects the market, right? So it is the money in the asset class, the volume between buyers and sellers. However, retail traders do not focus on it the correct way or view it correctly, right? As seen above, there's a lot of liquidity, then price doesn't have. When there's a lot of liquidity, price doesn't have to do a drastic move when a size trader enters or exits the market to fill their orders, right? Remember the basics of one buyer places an order for 3,000 ES longs at 4,100. If there's 3,000 sellers there at 4,101, then cool, orders filled, on to the next. The market doesn't have volatility in it, right? And now most traders try and use a DOM to measure this, and they fail horribly because they don't realize how to read the DOM correctly, and that they also don't realize there's a market maker controlling every order on that DOM, right? They can be controlled and manipulated to encourage traders to trade, right? Remember, indicators, DOMs, all this stuff, it's to make you feel comfortable and confident to place your hard-earned cash in a trade, right? Don't fall for it. The best way to measure liquidity, and you don't have, the best way to measure liquidity is to learn what it looks like, right? You don't have to have the same level DOM. You don't have the same level DOM as a market maker who sees the order flow coming in from the brokers. However, with all these fancy indicators and moving averages and casino mood setting having common is volatility, right? And as I discussed, now let's talk about volatility in the next lesson.